This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Current technicals and stock market charts say buy, but policy uncertainty, ebbing fundamentals, and valuations say, wait a second. No one knows which will prevail, but understanding the trade-off between potential risk and reward is more important than making predictions. Up next, let's discuss. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. The technicals, the recent market momentum argue for more gains. It's a bullish signal, while the fundamentals and valuations probably suggest a more sober outlook. Who will prevail? Well, of course, this is a bit of a cheeky setup because, of course, the answer is who the heck knows? I don't know, nor does anyone else. But at least we can frame the backdrop, right? The truth is probably somewhere in the middle. The story could indeed be getting better, but this epic recovery off the lows has left very little margin for error. A lot has to go right amid all the policy, economic, geopolitical uncertainty. So I think properly balancing the potential risks and rewards is going to be more important than trying to be a predictor, right? A soothsayer. So let's discuss that. A lot to get to today. But clearly the story du jour here in June has been market momentum. We're now almost 80 days off of the lows in April, okay? And it's been an epic rally. I mean, there's no getting around that or understating that. I mean, Ryan Dietrich over at Carson Group, he crunched the numbers. The 20% rally in 2 months that we've seen has only happened 5 other times since 1950. And in all 5 of those prior cases, stocks were higher 1, 3, 6, and 12 months later. The NASDAQ 100, that's where, a lot of the Mag 7 names reside, of course. A lot of the big tech names just printed an all-time high this week. So not just getting back to kind of where we were, but an all-time high, right? And that's probably the most bullish thing that an index can do. I mean, you don't get to all-time highs in the context of a bear market. Doesn't happen very often, right? And then in terms of the recent strength, just the last couple months, this is also according to Ryan Dietrich, in May and June, presuming we don't collapse on Monday, in May and June we've had gains. Whenever you've had gains in both of those months, going back to 1950, we've been higher the rest of the year 15 out of 16 times, up nearly 10% on average. You get what I'm saying. The precedent is for when you have this type of positive momentum, doesn't mean we're going to go up in a straight line, but when you had this type of positive momentum, it's much more of a bullish signal than a cautionary signal. What's more, if you factor in some of the geopolitics, Strategas was making the point this week that stocks are generally up 6 months after major U.S. military strikes, and they went all the way back to Pearl Harbor, okay, and looked at everything that's happened since, including Vietnam War, Bay of Pigs, Gulf War, Afghanistan, Iraq War, Libya. When the U.S. has gotten involved, the only 2 times the market has not been higher 6 months later was indeed Pearl Harbor, and secondly, Libya back in 2011. So this market's starting to feel a lot like what we saw in 2018 and in probably 1998. Those are the last 2 kind of periods that remind me of the current environment. I mean, if you look at the average number of trading days to make it back to the highs following a 15% correction, the average, again, this is also from Strategas, going back to 1950, is about 415 days. Median, 242 days. Well, in 98, it was only 33 days. 2019, coming out for the late 2018 sell-off, it was about 85 days. So here we are, roughly, 60-some days off of the April closing low? We're pretty darn close. We're within 1% of those all-time highs. So momentum clearly bullish. That is more of a bullish precedent, like I said, more than a cautionary precedent. One of the things I like is probably the wrong word to use, but one of the things I'm encouraged about is that the sentiment has not gotten overly bullish. This is not a euphoric period by any stretch of the imagination. I mean, if you look at all the things that I've tracked for a long time, the VIX, the Investors Intelligence bull-to-bear ratio, American Association of Individual Investors bull-to-bear ratio, inflows into ETFs and mutual funds. I mean, all these things that send the signal of extreme optimism or extreme pessimism, none of them are in the extreme optimism camp. You've heard that, it's a bit of a cliche, but you've heard the term, the market climbs a wall of worry. That's exactly what's going on. So we're not in a situation where everyone thinks everything's great. That is also probably a bullish sign. Means as markets go higher, there is fuel, right? There's more and more people that can go from negative to neutral, neutral to positive. We're just not seeing exuberance in any form. I would also just say, going back to geopolitics for a second, we know what happened with Iran and is happening with Iran and Israel, and I'll get to that more in a second. But if you go back, I made the point last week that geopolitical events, incidents, tend not to have a long shelf life in terms of market impact. And again, this is going back and all the way to World War II, Pearl Harbor, or even before that, when Germany invaded France. But if you look at where the downside was, where the exceptions were, really didn't have a whole lot to do with the actual geopolitical event. It was in the context of an already existing recession. So good example of that recently was 9/11, right? That came in the context of the dot-com bubble popping, a significant recession. So I'm not minimizing the impact of 9/11, but I think you could probably make the point that 9/11 in and of itself would not have been a sustainable drag on the market, for a period of months. So if you look at the periods where you've had a downside associated with geopolitical events, early 50s, early 70s, like I said, 2000 through 2001, they came in the context of an overall bad economy to begin with. I'm not sure that's the case today. I do think it's fair to say the kind of insane volatility we've had the past few months, and we certainly saw it a few years ago in COVID, right? A similar kind of V-shaped rally. I hate to say it, folks, it may be more the norm. If you look at the numbers, this is according to FactSet, we are on pace to have the most volatile stock market decade, at least in the last 80 years. According to my math, well, this is not my math, it's FactSet's math. According to their math, so far, as of this week, we've had 440 plus greater than 1% up days or greater than 1% down days. 440. And we're only, less than, halfway through, I guess we're slightly more than halfway through the decade. Put that in perspective. The 2010s, we only had 528 days for the whole year. So this is shaping up to be a very volatile decade. And what does that mean? You just have to keep your discipline. This is what I've been saying. Investor emotions, I think, are a much bigger enemy of portfolio success than geopolitics, policy, even recessions. Because it's how you react to those things, right? Those are what tend to cause the lasting losses. You cash out, you freak out. And we saw some of that in April, if I'm being honest. The other thing I'll say, and I said this last week, so I don't want to belabor the point, when you get this type of momentum, out will come the salesmen, the shucksters, right? We've seen it a lot with gold. I'm literally, every time I'm driving home, I listen to, talk radio on the way home from work. I'm hearing about somebody pitching gold. Why? Because it's up 30%. It's done well. So out come the people promoting gold. Here's something I have learned time and time again, and you maybe have too, but I'll share it anyway. Wall Street is great at selling you things that people want to buy. What does that mean? It means if there's something that they know they can sell to you, they're going to sell to you. They have a captive audience. So, for example, if the market's gone down 25%, guess what's going to come out? All kinds of products telling you how to hedge risk, mitigate risk. Of course, this is after the market's gone down, right? That would be a much more helpful advice when the market is up. And that's the better time to hedge, right? You don't get insurance once your house is on fire. Saw a study, again, I don't want to get too much into this today, but I saw a study that looked at so-called thematic funds. So you can get funds, ETFs and mutual funds that chase a certain theme. Well, the study suggested, I saw this in Bloomberg. I'm sorry if I don't have the proper attribution. I think it was Bloomberg. But the results are pretty clear. Over the last 3 years, the average dollar invested in thematic funds lost about 7% a year. Over the same period, S&P 500 gained about 11% a year. So what does that mean? It means people are chasing momentum. People are buying the news after the news has already unfolded. Don't mean to sound too pedantic here, professorial. I would just say be on the alert for that if you find yourself wanting to buy something. Seeing a little bit of that now with some of these international funds that are coming out. International's done great this year versus the U.S. Is that going to continue? Is that divergence going to continue at this pace? I would be a little bit skeptical on that. All right, let's go back to sort of the current environment. I do want to talk about the current backdrop. We're halfway through the year. And obviously, the last week and a half has been very newsworthy on the geopolitical front. I said last week, maybe somewhat cynically, that the investment markets tend to look past the human and sort of national interest aspects, particularly of Middle East conflicts, and really just focus on what's happening with oil prices. I know it sounds cavalier and, a bit cold, for lack of a better word, but that's the reality. To wit, last Sunday, so a week ago, last Sunday evening, crude oil spiked to over $80. By Monday afternoon, it was back down in the 60s. 15% move in less than 24 hours. Shows you how sensitive the oil markets in particular were to what was going on in Iran and Israel. And if you look at it, and again, Strategas did some good work on this, if you look at significant geopolitical events over the recent decades, there's a pretty consistent pattern. The reactionary spike in oil eventually tends to get sold, sometimes quite quickly. So, for example, just most recently, 2022, when Russia invaded Ukraine, crude peaked 7 days after the invasion. You go back to 2011, oil round-tripped just 2 months following the Libya attacks. 1990, oil rallied from August to October after Iraq's invasion of Kuwait. But by the time Operation Desert Storm began in January of 91, it was back below the pre-invasion levels. So you get what I'm saying? This is a big reason why these geopolitical events tend to not have a really long shelf life. I will also say in the current backdrop, the overall kind of supply-demand dynamic coming into this was favorable. When we had the Russian invasion of Ukraine, the market was undersupplied with oil. So there was a lot of vulnerability to any sort of disruption. This time around, kind of the opposite. We have an oversupply. Crude was already at a fairly depressed level. So that was allowed for probably a quicker resolution there. And even if the Straits of Hormuz were to be mined by Iran or jeopardized by Iran, I think the markets were feeling that would be a pretty quick situation. One of the big reasons is that China gets about 10% of their oil from Iran. So this might be one of the few circumstances where China and the U.S. both are putting pressure on Iran at the same time. Obviously, I don't know what's happening behind closed doors, but that would be my guess. So bottom line is the market has essentially forgotten about Iran. I know that sounds crazy to say, but that's the way the market's treating this. Good news is, okay, maybe we're on the other side of it. The bad news is market's kind of priced for perfection there, right? So any kind of restarting of tensions between Israel and Iran, or if Iran does something to further retaliate from the strikes the other day, market's not priced for that. So that could be a source probably of not of long-term volatility, but certainly short-term volatility. Big thing about oil that's relevant here in the United States, of course, is that President Trump has loudly proclaimed lower crude oil prices and lower gasoline prices as one of the hallmarks of what he's trying to do, right? And this country, we drive so darn much, right? Everyone has a car. We are particularly sensitive to gasoline prices. It's sort of the poster child for inflation. In fact, according to FactSet, if you go back to 2004, over the last 21 years, about 80% of the biggest jumps in inflation expectations have happened alongside a spike in gas prices. So that's a pretty big deal. The other thing that was less reported with the Iran situation and the possible blocking or mining of the Straits of Hormuz were the possible impact on food prices. It is a major transit point for fertilizer producers in the Gulf region, and Iran ranks among the largest global exporters of ammonia, which is used in, fertilizer and big-time, commercial farming. So, again, didn't get a lot of airtime. But alongside the spike in crude, you had a pretty significant spike in the prices of wheat, corn, soybeans, and eggs, of course, as well, which we know was a really big sort of pivot point in the election, right? I mean, you could argue that was a major driver of Trump's win, was spiking eggs prices. So I mention all this because the inflation backdrop, I think, is front and center. So the fact that oil prices have dropped back down into the 60s is a welcome development. Hopefully that helps to keep food prices in check. We will see. But enter the Fed, right? So the Fed has been very public, and they were public again recently, saying that, listen, we are not going to preemptively cut rates. We need to see what's going to happen here, right? But I think one of the reasons why the market did rally the last couple weeks is not just because of a calming of tensions, but this gives, with oil back down, food prices maybe coming in a little bit, we'll see. Maybe the Fed does have more room to potentially cut rates. Because if you look at the futures, the market is saying that the Fed's going to cut more than what the Fed is saying. So the Fed is saying maybe we'll get some rate cuts later this year, and if you believe their dot plots, maybe a couple cuts this year, maybe one or two next year. The Fed futures market is saying it's going to be more than that. And what's more, the Fed futures market is saying that growth is probably a bigger concern than inflation. That is not what the Fed's saying. The Fed's been saying that the economy is in pretty decent shape, but the markets are saying something different. So just to talk a little bit more about that, I think one of the other things that I have talked about more so last year than this year, but is getting kind of lost in the shuffle, is the disinflationary impulse from the shelter part of CPI, Consumer Price Index, i.e. housing. We've argued for some time, and I know Chase has as well, that not only would lower rent prices eventually impact inflation, but housing prices would probably calm down at some point, and that would work with a lag factor to keep inflation in check. So look at the recent data. I read something from Redfin just this week. Supply has been steadily rising on the housing front. Home sellers are now estimated to outnumber buyers by about 500,000. That's the largest gap on record, with data going back to 2013. Again, that's according to Redfin. That has to moderate price appreciation, at least to some degree, right? And really on that point, U.S. existing home prices rose just 1.3% over the past year. That's the slowest growth rate in the last 3 years. 1.3%. Meanwhile, the rental market continues to be affordable. Rents have now declined on a year-over-year basis for 24 consecutive months. So, again, the fact that crude oil has come back down into the 60s, housing is a depressant, I think, going forward. Hopefully that keeps inflation down because, as we know, we've got to deal with tariffs, right? Strategas has said that tariff revenue is now coming in at an annualized rate of about $190 billion a year. That's almost 0.7% of GDP. Now, we know that the tariff landscape can change, right? There are deals that need to be struck. But the data is not showing up in the currency markets, as we would expect. I mean, you would think that countries being hit with tariffs would have a depreciating currency. That's what happened in Trump Part 1 to China. That is not happening this time around. It's been the opposite, right? It's been the dollar that's been weakening. And we're not seeing it in the inflation data either, right? The last 3 months' worth of inflation data have been pretty benign. So our concern is that companies are eating that. I mean, someone's got to pay the bill. Maybe it is companies. But there'll be a trade-off, right? A lot of high-profile, large companies have announced price increases. I mean, we've heard from Walmart, Target, automobile companies, right? Volvo, Volkswagen, Ford, Procter & Gamble. Heard something from Best Buy, Black & Decker. I mean, major companies are going to be raising prices. But remember, the Fed doesn't just have an inflation mandate, right? They have two mandates, inflation and job stability. And while the unemployment rate remains low in the low fours, leading economic indicators or leading indicators of job slowing, and again, I talked about this last week, are definitely showing a cooling labor market. And we know that businesses are cooling off on hiring people or hiring plans, right? On top of cooling off on CapEx plans. There's a long-running study from Duke University's Fuqua School of Business where they poll something like 500 CFOs across the country, some publicly traded companies, some privately held companies, and they found that 40% of those surveyed postponed or outright canceled capital spending. So I think that probably applies to labor as well. In fact, the Richmond Fed CFOs survey just this week showed the steepest two-quarter decline since the first half of 2022. So again, the market, I think, as well as the consumer sentiment data and the business sentiment data, is showing a lot more caution than what the Fed is kind of publicly espousing. So again, I don't want to get too much into economics today. I'm just saying that even though the technical outlook for the market is very bullish, as I said 10 minutes ago, if you start to look at the fundamentals, it's going to be a tougher slog in my opinion. That's why I said at the very top, the truth might be somewhere in the middle, right? The story could be getting better. The precedent is for more gains, if you believe what other momentum surges like this over the last 50 years have portended. But I think it's very fair to say the market is priced for kind of everything working out well. The market is assuming we're going to get trade deals with a lot of our major partners. Market's assuming we're not going to have a reignition, if you will, of tensions in Israel or Iran or the Middle East in general. Market's certainly assuming that corporate profit margins are not going to collapse. But so what does this mean for you? I think what it means is a couple things. One, as I mentioned last week, we've had very much inconsistent sector trading. No one sector has led the market for more than 2 weeks in a row this entire year. Tech, healthcare, financials, no one's been in the leadership position for more than 2 weeks in a row. So that really augurs for diversification, right? What's been leading recently? Well, as I mentioned, the NASDAQ 100 back to all-time highs. Tech's back in the driver's seat. And in the poll car is NVIDIA, right? NVIDIA back to all-time highs after being down almost 50% from the highs at one point in April, early April. So tech has rebounded. Financials certainly doing better recently, but more defensive areas, consumer staples, utilities, healthcare, still not catching much of a bid. But that could change on a dime, right? If we start to get some more sluggish economic data, if we start to see, again, any sort of idea that some of these tariff deals aren't going to happen or get pushed back, or, President Trump's style, if there's actual ratcheting of trade tension, to try to force a deal, it would not surprise me at all to see a rotation go back the other way. I think the key thing is when you are managing a portfolio, they always say, it's a bit of a cliche, but amateurs think about how much money they can make. Professionals think about how much money they can lose. I think that's really good advice to follow. So whenever we do something, whenever we buy something or invest in something, we don't just think about possible returns. We think about, hey, if we're wrong on our thesis, what's the downside? And of course, sometimes that's hard to quantify, but we certainly think about those things. If you were really uncomfortable, if you were freaking out, if you couldn't sleep at the lows in April, you probably had too much risk exposure. You've been bailed out, right? by a 20% move off the bottom, maybe now is the time to think about that and say, you know what, I don't want to go through that again. I'm going to go from 80% stocks to 60% stocks. I'm just throwing out a random idea. That's obviously not investment advice. Think about that. Think about that because, again, I'm optimistic based on the precedent, but I think it's still going to be a circuitous path here over the coming months. All right, enough on that. As always, I like to transition to the specific. I do want to catch you up on a few individual stories. Stick with me. Back in a minute. Almost everything that lagged last year, value, international, and more defensive stocks, are first out of the gate here in 2025. Is this a knee-jerk reaction or a more sustainable trend? Tune in every week to hear Simon Hamilton and Chase Sanderstein discuss the latest financial trends and what investors need to know. To learn more about where to find the best future opportunities and how to become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. As always, when I do talk about some individual ideas, remember, the names I'm going to discuss are names that I own personally, and these are names that we own in many of our client portfolios. You can consider that a conflict of interest. Also know that if you are a client and you own one or more of these names, I think you can feel confident we've done our due diligence and we feel these are appropriate for your particular situation. If you're not a client, remember, you really have to do your own homework. I can't manage your portfolio, through the airwaves. I did want to comment just briefly on Berkshire Hathaway. I think everyone knows who Berkshire Hathaway is. Earlier in the year, they were riding high, and they were, I would argue, sort of a store of value when everything was getting crushed in April. They were one of the best performing large cap stocks in the S&P 500. But since Warren Buffett announced that he's going to be stepping down and moving into more of an advisory role next year, stock hasn't done great. It's down about 10% from those highs, and then sort of on a valuation level, they were trading about 1.7 times their book value, and now they're down to maybe 1.5 times book value. So there's been a lot of scuttlebutt, maybe the wrong word, but I've seen a lot going back and forth about, well, is that the Warren Buffett premium that was kind of baked into the stock, and now the market's stripped that out? Market's no longer giving them credit for the Buffett's expertise. Obviously, way too early to know if that's true or not. But I would push back on that. I think that might be a bit of an overreaction. Just to give you a few updates about Berkshire and kind of what's going on there. As you know, he's going to be handing over the reins to Greg Abel. Remember, Abel has been there for a while, so this is not some guy who's fresh off the street. He's been running most of the company, particularly their energy businesses, which is a big part of their business, for a number of years. I mean, well over 10 years. And he was kind of identified as the heir apparent some time ago. It's just a question of when, not if. So it's not like he's new to the business. He's already had a lot of success. And of course, at the heart of it, Berkshire is an insurance company, right? And Jane has been running that business for a long time. So, I mean, really, their two biggest business segments have not been run by Buffett in recent years. So I think the continuity there is going to be a lot more than people think. And I would also say, I think this is probably the biggest thing. Berkshire tends to trade as a more defensive name. So it's in times of sort of market stress that they often have some of the best performance. That's not the case the last couple months, right? So it really hasn't surprised me that Berkshire Hathaway has not been a market leader here the last couple months because it's been a risk-on rally, right? It's been tech, it's been financials, it's been more cyclical names. It's not just Berkshire. I mean, things like consumer staples, healthcare, I mentioned utilities, they've underperformed the last couple months. That could easily shift if we get any sort of market volatility. The other thing about Greg Abel is he is an operator, and I actually think he could drive some value among the businesses that Berkshire Hathaway holds because Buffett has been notoriously hands-off. He makes an acquisition like Burlington Northern. He lets those companies do what they do. Well, the reality is a lot of those businesses have not performed that well recently. I think Abel might come in and be much more hands-on and actually do a little bit more to drive performance, be a little bit more engaged in that collection and that portfolio. And of course, maybe the biggest thing is they're sitting on, as you well know, over $300 billion in cash. It's probably too much, right, for a company. It's probably an inefficient use of the balance sheet, and I'm sure Buffett would argue against that. But a lot of people have thought that on day one of him being handed the reins that he may take a much different approach to that cash, whether it's more buybacks, whether it's starting to pay a dividend, whether it's being a little bit more aggressive in maximizing the balance sheet. I'm not making a call here. I'm not making a buy or sell call on Berkshire Hathaway. Many of our clients have owned Berkshire Hathaway for over 20 years. We rarely have sold Berkshire Hathaway over the years, and for good reason. I mean, just look recently, just in the last decade, 6 out of the last 10 years, Berkshire's had double-digit returns and actually outperformed the S&P over the last decade. But if you also look at the long-term track record, there have been periods of time where Berkshire Hathaway has not been a great investment, where, Buffett has been declared to have lost his touch, right? And I think the lesson is no one strategy works all the time. Growth stocks are in favor sometimes, value stocks other times, international sometimes, domestic sometimes. That's part of the deal. That's why you diversify. So I don't see anything that would lead you to say, I need to get out of Berkshire Hathaway. Certainly there are risks there, right? I mean, their largest holding is still Apple, so they still have the risk of their underlying holdings. Also, the insurance business, companies have not been able to raise premiums as much as maybe they were able to a few years ago. So there's certainly risks to the Berkshire Hathaway story, but I don't know that the changeover to new leadership would be the main risk. I think that's what I'm saying. So take a look at Berkshire Hathaway, and if you're not an investor there, maybe it's something to take a look at if you're looking for a more defensive name. I wanted to mention Louis Vuitton. Louis Vuitton is a name that we started buying in some of our client portfolios earlier this year, and if I'm being blunt, it's done very poorly. Our timing was not good on it. The stock is down over 35% over the course of the last 12 months. And it's been a whole mess of issues with Louis Vuitton, but I would say the biggest issue is China demand. China, far and away, the biggest consumer of luxury goods, the type of goods that Louis Vuitton is known for. And that traffic has been way down as the China economy has been somewhat sluggish over the past couple of years. Obviously, this trade war is very challenging as well. Louis Vuitton, and of course, is a French company, and they export goods to the United States, China, other places. So there's just been a lot of issues, and I think maybe the biggest concern of Louis Vuitton is their collection, right? They're a hodgepodge. I mean, they have 50 brands across 5 different sectors, and people are wondering if they've become kind of too disparate, right? And whether that sort of conglomerate structure should work. Should they be more refined and targeted in terms of the brands that they offer and cross-sell, leverage, market in a more specific way? We'll see. I mean, the goods, right? They own, of course, they're in the liquor business with Hennessy, Moët and Chandon, Christian Dior, Bulgari, Sephora, the favorite place of my teenage daughters, all kinds of other watches and jewelry and selective retailing businesses. I still think Louis Vuitton has the best collection of luxury goods in the world. I think that's unsurpassed. It's just that the demand outlook for a lot of those goods and maybe the corporate structure needs to be refined. That's sort of the bad news. The good news is the valuation is kind of washed out here. I mean, this is the cheapest the name's been in a long, long time. I would expect this quarter's worth of earnings to be lousy. I'm not expecting an immediate turnaround, but I do think everybody knows that. I mean, no one's positive on the name right now. So I think it's a value stock. It's a value stock in what traditionally has been a growth sector. So the risks are obvious that their turnaround takes longer than what people hope for, but given that management expects a return to growth, and I think there'll be continued pressure on management to drive performance, with the valuation as low as it is, maybe the risk-reward trade-off is starting to stack in your favor. But you're going to have to be patient here. This is not going to be a get-rich-quick situation, as none of our names are, by the way. Just want to hit on one or two others. Goldman Sachs had their annual global healthcare conference recently, and one name kind of stood out for us, and that was Merck. Merck, as you probably know, has had a really tough time the last few years. I mean, 3 years ago, I guess 2022, they had a really strong year when the market did not have a strong year. And they were trading about 17, 18 times earnings. And that was when Keytruda, their kind of do-all cancer drug, was exploding, not only in terms of market share, but also in terms of applications to all different types of cancers. And like I said, its stock was trading in the high teens from multiple perspective. Since then, it's been a tough slog. All kinds of stuff going on with them. Not only is Keytruda coming off a patent in a few years, their Gardasil business in China, which is their HPV vaccine, they basically zeroed out potential revenues there, which I don't think will ultimately be the case, but market has essentially assumed no growth and really no revenue contribution. Of course, we know what's going on with RFK Jr., NIH funding. That's been a general overhang on pharmaceuticals, and in some cases specific to Merck as well, because they do have a vaccine business. And of course, there's the other threat of pharmaceutical tariffs that President Trump has lobbied. On that front, they said at the conference that they're having ongoing dialogue with the administration, which they characterized as very constructive. They think that they'll be able to work out something that maybe puts a little bit more pressure on the pharmacy benefit managers, like the middlemen, rather than the drug companies themselves. They also talked about their pipeline, which the market is assigning very little value to. So here you have Merck now trading at about, 8.5 times forward earnings. Less than half the multiple of a few years ago. So, I mean, it seems to me like if anything goes right for Merck, if anything goes right for them, that the stock may have the opportunity to rebound. They still pay a decent dividend, ironclad balance sheet. So again, from a risk-reward trade-off standpoint, Merck certainly has risks, regulatory risks, policy risks from not only RFK Jr., but also from President Trump. And not to mention, there's always research and development risks with any pharmaceutical company. But I think the valuation, maybe in the same way that I might talk about Louis Vuitton, the valuation reflects a lot of negativity. Last one I'll mention today, Costco reported their earnings a couple weeks ago. I didn't have time to get to it last week. They have sort of the opposite problem, if you will. Well, I shouldn't use the word problem, but the opposite sort of backdrop in the sense that things have been going really well for them. They've been executing at a very high level, but the multiple reflects that execution. They're trading over 50 times earnings. So it's actually, I think it's the most expensive stock in our portfolio. So again, it's not a value stock. It's a growth stock trading at a higher multiple. However, Costco has shown such consistent execution that you can make the argument that the multiple is justified. I mean, once again, heavy traffic, resilient average ticket, even in a slowing consumer backdrop. Opening up a bunch of new stores. They should have about 25 net new annual openings over the next 5 years per year. They've had a really good track record so far of absorbing tariff pressures and not having to pass those along to clients in any meaningful way. By the way, they did the same thing a few years ago when everyone else was getting killed by supply chain challenges during COVID and having to raise prices. Costco, because of superior execution, supply chain management, warehousing, inventory management, they were able to hold the line on pricing. And remember, really where they make their money is on the annual membership fees, and they have almost a 93% renewal rate, and they had total paid memberships were up 7% on a year-over-year basis. So not only are they keeping customers, they are growing customers, and so far they've been able to weather the tariff storm. So again, different than Merck, different than Louis Vuitton, and maybe different from Berkshire Hathaway in the sense that they have a premium multiple reflecting really strong execution. So that would be the risk, that they're kind of priced for perfection. But I think given their track record, it's not a bad place to be positioned if you want to have some consumer discretionary exposure, but you feel uncomfortable with a restaurant or a hotel or an airline, something that could be a lot more sensitive to an economic downturn and maybe a ratcheting up in trade tension. So consider that risk reward with Costco. So again, different types of companies, different investment profiles and valuation profiles, but all might be worth a look. And again, as I mentioned at the top, if you're not a client, please make sure you do your own homework. Make sure they are right for your particular portfolio. I think I'll leave it there. Over the next few weeks, I think Chase and I will get more specific with you on some of what we're hearing from individual companies. We're very curious to see and hear second quarter earnings, how companies are thinking about tariffs. If, in fact, our company is going to see some hits to their profit margin profile if they're absorbing a lot of those tariffs and not passing them along. That will be a central issue that we'll be focusing on. Stay tuned for that. And as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.